Hello everyone, welcome to the February edition of Monthly Viewpoints. We have with us our fund manager, Mr. Dhaval Shah today to share with us a view on markets and the outlook going forward. So to begin with, I would like to ask Dhaval, how have the markets fared overall globally and on the domestic front in the last month?
Sure. So if you look at global equities, we have had a very strong start to the year and we continue the momentum that we had in the month of December. Despite rising geopolitical tensions between US and Iran, markets were rejoicing the fact that US-China trade deal phase 1 actually happened, and that is where overall global equities were fairly strong. However, to the fag end of the month, markets across have been largely been concerned with fears of coronavirus impacting the overall global demand. If you look at oil prices, which is one of the key indicators to assess global demand, that's down like 15% month on month in the month of January, indicating that there could be a global slowdown because of the coronavirus issues that we have on hand. If you look at FII numbers, we've had fifth consecutive month of inflows. This month was around $1.4 billion, which was again a good record to have with. When I look at the Indian equity markets, one of the key standing points which has been is that mid and small caps have started participating over the last 2 months. In fact, now if you look at the 6-month return for mid and small cap versus Nifty, we are at around 16-17% absolute return over the last 6 months versus Nifty at around 12%, indicating that the breadth of the market is actually improving over the last 6 months, which is fairly encouraging versus the last 2 years where there was high polarization towards say like large cap stocks. So that's where we stand on the overall global as well as Indian equity markets.
So that's nice, Dhaval. Now this month started with 2 key announcements, one being the union budget and the second is the monetary policy. What were the key takeaways and how have they panned out for the market?
Sure. So if you look at the union budget was presented on 1st of February, and key takeaways from the budget was that the whole budget was centered around attracting more foreign capital, be it for the equity or the domestic flows that you're trying to classically look at. And secondly, it was also more about trying to say that how can we improve on the overall growth rate from where we are today. While markets had a lot of expectations in terms of consumption doleouts, which have actually not come as much as the markets expected, but clearly budget has given some kind of a consumption boost also when we look at the broad numbers. In terms of fiscal deficit, all economists were pointing that this year will end somewhere at around 3.8% kind of a fiscal deficit number. But more importantly, for next year versus an FRBM target of around 3%, we've taken that extra leeway of 50 basis points and we're now targeting around a 3.5% kind of a fiscal deficit, which is much required because the growth has slowed down to around 5% kind of a GDP number that we're trying to classically look at. Also, if I were to look at the budget math, growth is reasonably anchored around a nominal GDP growth rate of around 10%, providing some kind of an authenticity in terms of the projections that you're trying to classically look at. Finance Minister also taken pains to point out that they still remain committed to doubling of farm income by 2022, which is positive for the overall rural economy. More importantly, subsequent to that, RBI has come out, with its own policy, wherein it has pointed out, an important parameter in terms of high frequency indicators showing some kind of an improvement, indicating that there is a revival in momentum that we are trying to look at. RBI has reduced this year's growth rate to a number which is closer to 5%, but next year's growth rate is pegged at around 6% kind of a number. And more importantly, while they have maintained the overall repo rate steady at 5.15% as well as their accommodative stance, what they have done is a classic LTRO. Wherein they have given liquidity into the markets to the tune of around 1 lakh crore and also ensured that they take steps which will lead to better transmission of rates, especially at the shorter end. and that is where they have given concessions in terms of CRR exemptions for select sectors like auto, residential housing, as well as loans to MSME, which will help in terms of reducing rates for a lot of these sectors which are consumption oriented for the overall economy.
Great. So on the other side, we see that the earnings season has already begun. How is it faring so far?
So if you look at Q3 numbers, and if I look at 50 companies in the Nifty, almost 35 of them have now reported numbers, which is 70% of the Nifty which is reported. Numbers have been fairly encouraging, with many of them actually reporting in line or above expectation numbers. Many of the sectors which this represent is largely auto, private banks, NBFCs, FMCG and software, wherein the numbers have actually been either in line or above expectation. While revenue growth has been fairly muted across, which is indicative of the overall slowdown in the economy, more importantly, EBITDA margins have improved, because of good cost control across various sectors, and PAT margins have also actually improved because of the corporate tax rate cut that we're trying to look at. So we have companies in Nifty where the overall PAT growth has been greater than 30% for quite a few sectors, largely because of the tax rate cut, which is an important impetus even going forward.
So Dhaval, how does all this put together pan out as an outlook for the market? What do we expect?
Majority of the two key events are behind us, and when we look at Union Budget, though it has not provided the so-called demand side boost as much as people were expecting, now there is a clear sign of a gradual recovery that we should expect out of the overall markets. One of the important parameters is rural inflation, which has actually cropped up across, specifically on the food side, which should help in terms of the overall traction that the rural economy can see. And we would think that because of that would spiral into a wage growth and eventually overall consumption pattern that we are trying to look at. So our sense is we are somewhere near the overall bottoming out process in terms of a cyclical degrowth in the overall economy, and from here on you should see that upswing actually coming on, and we expect that all these parameters should lead to very decent earnings growth of somewhere above 15% over the next 2 years that we are trying to look at. So we would think that economy should actually see an uptick from here on. Key risks that we should monitor are largely global. We spoke a bit about the impact of coronavirus on overall global demand. If that were to escalate from here on, then you could see a slowdown in the overall global economy, and will also have repercussions for various Indian companies which are related to the export oriented sectors that we're classically trying to look at. If you were to look at from a large cap mid cap perspective, risk reward is fairly balanced for large caps today. They are fairly priced for the next 2 years of earnings recovery that we're trying to look at. However, mid caps are fairly attractive versus the long term average, and we've seen that over the last few months they have actually seen a very smart recovery. We expect that process to continue over the next 12 to 18 months, and that is where we would think that small and mid cap still have a room to catch up versus large cap. Select themes that we're fairly excited about, consumption, specifically low ticket consumer discretionary, and even retail that we're trying to look at. We find a lot of companies actually showing a very decent set of growth in these sectors. In terms of financial sector, we continue to be overweight private banks, and we continue to think that they continue to gain market share from public sector banks. Corporate banks and insurance companies, this another subsectors within them are also something which looks fairly attractive currently. The other two sectors where we're fairly bullish is cement and pharmaceuticals. In both of these sectors, we find that there is a gradual recovery which is happening in the key parameters that we're trying to look at. which should help the sector from the next 2 years perspective. So while on an overall headline number, returns could be modest because large caps are finely priced, we still feel that the broader markets have a good room to catch up, and that is where you should have an overall balanced allocation, more tilted towards small and mid cap, which will help you to generate returns from the market.
Thank you, Dhaval, for sharing your views. Thank you, viewers, for listening to us. Have a nice day.